Right now, in 2026, the standard set it and forget it target date fund is acting like you're retiring in 2040, not 2026. Imagine you're saving $200 a month and hit your goal this year. A typical 2026 TDF might still hold a massive chunk in stocks, but its glide path is built to slowly drift into bonds over the next 20 years. That's fine for a 30-year-old, but for you, it's too slow. You need capital preservation, not a decade-long transition. Think about your debt. Say you owe $20,000 on a credit card charging 22% interest. If you pull your retirement money out of a TDF to pay that off, your TDF might drop 10% in the short term. But paying that $20,000 saves you $4,400 in interest the first year alone. That's instant wealth. The market environment has shifted too. Rates are higher, which means bonds that used to be safe havens now compete with risky assets. Plus, AI disruption is reshaping entire industries overnight. A portfolio weighted 80% to tech stocks could plummet if an AI breakthrough hits hard next quarter. A standard TDF doesn't react fast enough. It's stuck on a generic schedule. You need a custom withdrawal strategy. Instead of waiting for your fund to slowly mature, you could pull a set amount every month to create your own glide path, shifting your personal risk profile instantly. Or, if you have a small emergency fund, keep your TDF untouched and tap into a high-yield savings account for liquidity. The point is, the default settings for 2026 are designed for a slower retirement, not a rapid exit. You have to adjust the dial to match your actual timeline, or you're leaving free money on the table while waiting for a future that won't happen. Target date funds are built on a very simple, almost mechanical assumption that your risk tolerance changes in a straight line as you approach retirement. Think of it like a clock winding down, where the needle just keeps spinning toward a single, preset destination. But life isn't a clock. It's messy, unpredictable, and full of personal variables. Take a 40-year-old who's just starting their journey. They might have a high tolerance for risk, wanting their money to grow aggressively, but a standard TDF might be dragging them back too early, assuming they're closer to retirement than they feel. On the flip side, imagine a 65-year-old who's finally retired. They might need that money to start paying for healthcare, travel, or daily expenses, but their TDF could still be holding on to a lot of risky assets, assuming they'll live off dividends for decades. It's like buying a car with the wrong tires for the road ahead. Consider a hypothetical scenario where someone says, I saved $200 a month for 20 years, and now I'm 65. Their TDF might be sitting at a 40% stock allocation, which sounds safe, but what if they need that money in 3 years? The fund is still geared toward long-term growth, not immediate income. Or imagine someone who's 40 but plans to work part-time until 70. A standard TDF assumes they'll retire in 20 years, but their actual timeline is 30. The fund's glide path is off, creating a mismatch between where they are and where the money is expected to go. It's not just about the numbers, it's about the story behind them. If your life doesn't fit the generic mold, your portfolio might end up too conservative, too aggressive, or just plain misaligned with your real needs. Think about how a target date fund actually works under the hood. It doesn't just pick a starting mix of stocks and bonds, and then slowly drift toward a safer, more bond-heavy blend as you get closer to your retirement year. Instead, it assumes your risk tolerance changes in a perfectly smooth, predictable line based on time. But time alone isn't the whole story. What really matters is when the markets decide to drop. Let's imagine a scenario where you're aiming for retirement in 2026, which is right now. You've been saving steadily, and your fund has been growing nicely over the last decade. Its long-term average return looks great, maybe even 8% or 9% a year. That sounds secure, right? But what if a major market correction happens in the final 18 months before you stop working? A standard target date fund might still hold a significant portion in equities because, by design, it hasn't yet shifted to its lowest risk setting. If that downturn occurs just as you're ready to cash out, you could lock in a massive loss right when you need the money most. This is the timing risk that often gets overlooked. It's not about what your portfolio did on average over 30 years. It's about what your portfolio does in the specific months leading up to your exit. A fund that blindly follows a glide path might be too conservative too early, leaving you exposed to a crash, or too aggressive too late, forcing you to sell at the bottom. Your retirement shouldn't depend on when the market decides to hiccup, but on how your allocation adapts to those exact moments. If your life doesn't fit the generic mold, your portfolio might end up too conservative, too aggressive, or just plain misaligned with your real needs. Think about the mechanics of what's happening right now. You have a target date fund designed for 2026, and the market is surging upward. Because these funds are engineered to become more conservative as you approach retirement, a rising market triggers a specific kind of drag. Imagine you've been saving consistently for decades, and your portfolio has grown significantly. Now, in 2026, the target date fund automatically shifts a larger portion of your money into safer assets like bonds to protect your gains. But here's the catch. That protection comes at a cost. While the broader market might be delivering double-digit returns, your fund is locking a chunk of your capital into lower-yielding instruments. Over the course of a 30-year retirement, that difference compounds. A 5% gap between what your portfolio could have earned versus what it actually earns, multiplied by 20 years of compound growth, can amount to millions of dollars by the time you start drawing income. This isn't just a minor inefficiency. It's a structural penalty that hits hardest when you need those returns most. If your retirement plan requires aggressive capital growth to cover inflation and a long life expectancy, a fund that's systematically slowing down your growth exactly as the market heats up effectively penalizes you for doing your job well. You're leaving money on the table not because of bad luck, but because of a preset rule that assumes a one-size-fits-all timeline. By the time you realize your portfolio has lagged behind its potential, the opportunity to reclaim those lost years of compounding growth has already diminished. That's the hidden tax of automatic de-risking in a bull market. It turns a rising tide into a slower, more sluggish current, potentially straining your ability to sustain a comfortable retirement for 3 decades. Right now, in 2026, you're paying a hidden price for convenience every single day you hold a target date fund. Think about how a target date fund charges an expense ratio that often sits between 0.5% and 1%. That might sound small, but imagine you've been saving $200 a month into a retirement account since your early 20s. Over 3 decades, that 1% fee compounds silently, shaving off thousands of dollars from your final balance. It's like paying a toll on every dollar that grows, without even noticing it. Now, contrast that with a do-it-yourself portfolio built around low-cost index funds. You might only pay 0.1% in total expenses, freeing up 0.9% of your returns every year. Over 30 years, that difference could add tens of thousands to your nest egg. But here's the kicker. With a DIY approach, you have the power to choose your asset allocation. If you're retiring in 2026 and feel comfortable taking on a bit more risk, you can stay invested in a higher percentage of stocks for longer than a target date fund allows. Say you want 80% stocks and 20% bonds instead of the 50-50 mix a typical 2026 fund might give you. That extra exposure to equities could mean higher returns, especially in a strong market. You're not stuck with a one-size-fits-all strategy. You're not forced into a sluggish glide path that slows your growth just as you need it most. Instead, you're in the driver's seat, tailoring your portfolio to your actual risk tolerance and time horizon. So, while target date funds offer ease, they come with a cost, both in fees and in flexibility. And when those costs compound over decades, they can erode your ability to maintain the lifestyle you've been saving for. Right now, in 2026, you're likely feeling the bite of high inflation in your daily spending, yet your retirement account might be quietly surrendering ground to it. Consider what happens when prices for groceries, healthcare, and housing keep climbing faster than the returns on your savings. If your target date fund is heavily weighted toward bonds and cash as the retirement date approaches, it acts as a shock absorber, but not always enough to keep pace with the real cost of living. Imagine you started saving in your 20s and now, at 45, you're looking at a portfolio that's mostly fixed income assets. Over time, those stable returns might lag behind inflation, meaning by the time you hit 60, your money buys less than it did when you first invested. That's a real-term loss of purchasing power, even if your account balance looks like it's growing in nominal dollars. Think about how a target date fund automatically reduces risk as you near retirement. While that makes sense for someone retiring in 2050, for someone like you aiming for 2026, a conservative allocation can feel too cautious when prices are rising fast. Say you've been saving consistently and built a nice nest egg, but inflation erodes its value before you even start drawing it down. By then, your portfolio might struggle to generate the growth needed to maintain your lifestyle after you retire. Instead of a glide path that slowly slows your growth, you might need a more volatile, equity-heavy approach that can harness market rebounds to outpace inflation. This doesn't mean ignoring stability entirely. but rather recognizing that a strictly declining risk profile might leave you underprepared when every dollar costs more than before. The goal is to ensure your savings not only grow but also preserve their buying power against the relentless push of inflation. Say you are sitting with a $10,000 target date fund today. It looks neat, right? One button, one fee, and it's supposed to get you through. But what if you could keep that simplicity while adding a little more fuel under the hood? Here's how. Instead of dumping your money into a brand new custom mix of individual stocks and bonds, you can buy a target risk version of the same fund family. Many providers now offer a target risk slider that lets you shift your allocation without leaving the familiar TDF ecosystem. You keep the automated rebalancing, the single fee structure, and the tax efficiency, but you move from a conservative glide path to a moderate or even aggressive glide path that matches your actual age and risk tolerance. Another option is to swap your current TDF for a custom TDF that mimics your desired asset allocation but uses a higher equity tilt. For example, if your current 2026 fund sits at 60% stocks, you could rotate into a custom version that holds 70% or 75% stocks, effectively giving your portfolio more room to grow while still feeling like a single, easy-to-manage product. If you prefer a DIY approach, you can layer a small amount of a low-cost index fund focused on international or emerging markets into your existing TDF, boosting diversification and potential returns without overcomplicating things. The key is to stay intentional. Don't just accept the default glide path. Ask what your true risk capacity is, then tweak the underlying allocation accordingly. This way, your savings not only grow but also preserve their buying power against the relentless push of inflation. Imagine you just pulled your savings out of a generic target date fund and looked at the balance. That number is only as useful as the plan behind it. A static withdrawal rate, like taking 4% of your portfolio every year regardless of what the market just did, often leaves you exposed when prices swing. Instead, think of your withdrawal as a living system that reacts to the specific terrain of 2026. If stocks dropped sharply earlier this year, your portfolio might look smaller than it did a year ago. A rigid 4% rule now could mean selling too many shares at a low point, locking in losses and thinning your cushion for the next decade. A tailored approach means adjusting that withdrawal amount based on recent performance. Say your portfolio dropped 15% in the last 6 months. Rather than cutting your spending immediately, you could temporarily reduce your withdrawal to 3.5% to let the market recover, effectively creating a buffer against future volatility. Conversely, if your portfolio is up 20% and you need to cover rising living costs, you might safely pull 4.5% without touching your core principal. This dynamic method ensures you're always selling high and buying low over time, rather than selling low just because your account balance took a hit. It also lets you incorporate other factors, like unexpected expenses or changes in tax law, into your cash flow without derailing your entire strategy. The goal isn't just to survive the next few years, but to thrive through them. By aligning your withdrawals with the actual behavior of your investments, you create a more resilient path toward retirement that adapts as the economy shifts. This flexibility gives you the confidence to stay invested even when headlines turn red, knowing your withdrawal plan is built to handle the unique conditions of right now. Think about the specific mechanics of your withdrawal timeline. Right now, in 2026, you're not just looking at a generic horizon. You're managing a precise exit strategy where every dollar withdrawn impacts your remaining capital. If you are drawing down from a target date fund designed to glide toward a 60/40 portfolio by 2030, your fund might be shedding equity exposure too slowly for a market environment that demands immediate stability, or perhaps too aggressively if you need to capture remaining growth to fund your final years. The key is alignment, not assumption. Instead of accepting the default glide path, ask yourself if your current allocation matches your exact 2026 cash flow needs. Start by assessing your current TDF allocation against your projected annual spend. If your fund has dropped below 40% equity exposure, but you need 55% to maintain purchasing power given current inflation, a shift is necessary. Next, calculate the required return you must generate over the next 12 months to bridge the gap between your principal and your withdrawal targets without eroding your principal too deeply. Finally, decide within the next 30 days whether to shift to a custom mix that locks in your ideal asset percentage or select a different TDF variant with a later target date that keeps your equity exposure higher. Don't wait for the market to dictate your pace. Proactively adjust your portfolio to ensure your retirement income remains robust and predictable. Take action this month to align your investments with your real-world financial reality, giving you the confidence to stay invested even when headlines turn red. Knowing your withdrawal plan is built to handle the unique conditions of right now.